Tom Lee is back. He's giving us new insight into our markets. And yes, if you were wondering, he's still bullish. Take a listen to this.
My next guest says stocks have risen in June for the right reasons, softer than expected inflation, and he is seeing more positive signs ahead, and he's sticking with the big names in AI. Tom Lee is here. He's Fundstrat Global Advisors co-founder, managing partner, and head of research, and he's a CNBC contributor. It's great to see you.
Yeah.
I want to start in a little bit different way than normal because Doug just made a really interesting point about millennials and how they're so conservative in their positions. And whether you've experienced this phenomenon firsthand or not, what do you say to those who need to be coaxed into a market that is ever at record highs after a run in stocks like Nvidia, like we've rarely before seen? I mean, is the water still safe?
I know investors generally aren't comfortable buying things at a high, but if we're mid-cycle, which we probably are, then we're going to be making a lot of new highs over the next 5 years anyways. And I think there's a lot of statistical support showing buying at new highs actually has a better win ratio than attempting to buy at lows.
Well, it's also true that for all of our lifetimes, the stock market has generally gone up. So yes, there are pullbacks. Yes, there are corrections. Yes, there are financial crises. Yes, there are pandemics. But is there any reason to believe that the fundamental nature of the beast has changed for the worse? I mean, I read this research sometimes, I'm sure you've seen it, that says, oh, we're going to have permanently lower stock returns now. 4% a year is the most you should expect and things like that. We've pulled forward gains. I mean, do you believe there's credence in any of that?
I've heard that exact statement about the new era of low returns since 2008.
Right.
And stocks have compounded at pretty much the historical average since 2008. I think as long as there's skeptics out there, that means there's a lot of fuel for upside.
Mm-hmm. So is Nvidia the thing that you look at and go, well, this could spoil the party, i.e. it becomes too much of a good thing. It really starts to lift into some kind of bubble, draws people into the market, really extends valuations, and we have to clean up the mess.
There's a lot of people trying to top tick Nvidia, saying that they don't want to own it because it's expensive, but it's a 30 PE stock that sells something that no one else actually produces in the world.
The one thing it's not is expensive.
Yeah. So I'd say I'd feel very differently if if we were discounting Nvidia being larger than global GDP and at 100 PE, and everyone's saying there's no way it can be stopped. But because everyone wants to sell Nvidia and try to call a top, I actually think there's still a lot of upside.
When I hear anecdotes, like I heard at a fundraising thing the other night about how all the local kids own Nvidia, what should I think when I hear that kind of information?
Well, it makes sense. I mean, Nvidia is the largest stock, so I mean, everyone should own it. It's almost like if someone said, I'm selling because everyone owns the S&P. I mean, everyone should own some S&P. It's really a bearish sign when someone says the S&P won't ever go down. And I only hear people saying the S&P's topping right now.
I do remember people saying stocks never go down a couple of years ago. Then we finally had a correction. I think we've had a couple maybe since then. What kind of paradigm are we in now? We hear people saying, like Mark Zandi did, well, the Fed needs to cut because otherwise the economy could take a turn for the worse. We know rates are probably higher than they need to be. Do you need to have a view on Fed rate cuts in order to support stocks continuing to move higher?
To an extent, I think that the big lesson for the last 2 years is the S&P has endured some pretty severe rate hikes. So we know companies are managing this cycle well. If the Fed turns neutral or dovish, that's even more positive for stocks. So I think that the environment for equities still is good because they survived a stress test. It's only bad if the Fed has to raise rates.
So I don't think it's much of a surprise to any of us that Tom Lee is still bullish on markets, and specifically the same areas of the markets that have been doing well. Tom Lee is specifically bullish on markets because he believes markets have been moving higher because inflation has been falling. And that is true, but it's not having a broad-based impact on your average stock. In fact, you have 10-year treasury yields that are down well over 40 basis points in just the last month or two, and small cap, interest rate sensitive, mid cap stocks have actually declined quite a bit in that same time frame. There has definitely been a worry about economic growth in recent weeks. So yes, historically, as inflation falls, it does mean the economy is slowing down. And that's not necessarily good for markets either, as I'm sure you know. It's really a fine balance between a little bit of weakening and the Fed starting to take their foot off the neck of markets. Meaning, in simpler words, the Fed starts to talk about at least cutting rates, and it seems like 2 weeks ago, the Fed really pushed back on that. The Fed went from pricing in or expecting 3 rate cuts this year down to 1. And it really didn't sound like the Fed was too confident in even giving us 1 rate cut. And that's why areas of the markets have just pooled all the capital into AI stocks. Because after all, if you have to be invested in our markets, small caps, mid caps don't look that attractive because the Fed is not really our friend at this point. And AI seems to be getting all of the growth and all of the love by investors. Honestly, it's not a bad strategy, but there has been some problems in paradise, specifically with Nvidia. Nvidia is now down about 9% in just the last couple of days. Even though Nvidia is now down 9%, the RSI is still very overbought at 78, almost 79, and that just shows you how much Nvidia has really run recently. And that is looking at the RSI on a weekly candlestick chart, because I think that's a good representation of what the actual relative strength looks like. If you look at the RSI on a daily chart, then the RSI looks much better at 64. I also think it's worth mentioning that yesterday was the largest option expiration we have ever seen in the history of the markets. Like literally there's never been a expiration with so much money on the line. Specifically about $5.4 trillion. But what I've noticed over the years is you actually don't get a volatile week of the actual OPEX, meaning that this Friday was the big option expiration. It makes sense why last week was pretty uneventful in that regard. You kind of just went up. That was the overall trend. There wasn't a lot of back and forth volatility. And that's because there's a lot of options that were on last week's option expiration options chain, and they were already hedged for by market makers in different directions. So there wasn't a lot of money moving around. But what actually tends to happen is the following week after a triple or quad witching tends to be a little bit more volatile. We are also going to get into the start of earnings season this upcoming week with FedEx that reports earnings Tuesday and after hours, Paychex Wednesday pre-market, Micron, which could be important for your AI trade, BlackBerry and Levi's Wednesday and after hours, Walgreens Thursday pre-market, and then followed up with Nike in after hours. As earnings expectations are pretty high for really everything, earnings expectations are pretty juiced right now, you really have to come out and impress investors. Even when you think about something like a FedEx that is very cyclical to the consumer and people spending money, which that doesn't look so good lately, it's sitting at almost all-time highs. So just judging off of where markets are, you really need to see an impressive earnings season. We will also have some data coming out this week, like I shared in the last video. Dallas Fed Manufacturing Index on Monday. On Tuesday, the inflation rate out of Canada, S&P Case-Shiller home price year over year and month over month, CB consumer confidence, and Richmond Fed, as well as Dallas Fed service data that will be coming out at about 9 o'clock in the morning Tuesday. On Wednesday, new home sales month over month, as well as for the month of May. That's pretty much it for Wednesday. Wednesday could be the slower day. Thursday, you're going to get durable goods orders month over month. That is vitally important in judging how strong the economy is, as well as that final number for the GDP growth rate quarter over quarter. And that will be another big one, as well as continuing jobless claims and initial jobless claims that are actually expected to rise again. And this would be a couple of weeks in a row. 1, 2, 3, 4, 5, could be 6 weeks in a row, really confirming this upwards rise in initial jobless claims. Friday is going to be your big data with core PCE month over month. You're expecting 0.1%. That is going to be a big catalyst. Personal income month over month expected to actually rise to 0.4%, and personal spending month over month is also expected to rise from 0.2% to 0.3%. All of this data will be important because markets, we want to know, is the Fed too late? Did they already make an error? Is the economy going to continue to weaken? And if it is going to continue to weaken, how fast? How much? Is that going to mean the Fed's going to cut rates in July? Is that going to be September, November, December? the markets really just have no idea. The Fed was so ambiguous, they really didn't give us any new information, besides a hawkish dot plot. So I think from that perspective, any new information this point forward can have a large impact on our markets, especially considering it's a low volume period ever since the beginning of May, which tends to happen. Summer is usually sees less volume in markets. Then those low volatility sell-offs or rallies can be very aggressive. And we did talk about the option activity for this upcoming week in the last video, which is definitely on the bearish side, or at least the defensive side. On the call side, open interest is 13.07%. On the put side, about 87%. That means there's almost 7 times as many puts than calls. And I did have a couple of people on the last video that said, if everyone's positioning bearish for this upcoming week, does that mean that maybe we rally? And of course that's possible, and well, I generally agree with being a contrarian, but it's important to remember that Friday was a $5.4 trillion option expiration. What you're seeing now is really just the start of some of that money repositioning. So you could still see 95% of that $5 trillion get redeployed back into our market. So you've only seen a fraction of the redeployment of that capital. And so far it looks like firms are taking more of a defensive stance. As there is more puts that are bought on our markets, if stocks do fall, that means market makers have to start shorting a bunch of stock as you start hitting critical levels of support, major strikes for open interest, and that can lead to more shorting, and then more shorting, and then more shorting. Kind of like calls can lead to a rally in the markets, because everyone bought calls. If the markets keep going higher, market makers have to keep buying more stock, and then eventually they'll give you a sharp reset so they can get out of some of those positions. But I think you're just starting what could be a new trend based on the $5 trillion of money that just expired on Friday. So again, we could, yes, start a new uptrend for markets and continue this uptrend, or this could start a new downtrend for markets. I want you guys to take a listen to these clips from CNBC. They're short, sweet, straight to the point, specifically in regards to Nvidia and AI. And then I will give you my take on what I think is coming next for markets.
You seem to be calling a top in this AI hype, and you think stocks are going to move sideways from here at best?
Yeah, so I think we're at a short-term sort of tactical top in this frenzy that we've seen over the past month, where the upside is really accelerated. If you look at the largest cap names that have reported earnings in May and June, you've seen a situation where estimates have risen by anywhere from 0 to 7%, yet you've seen stock prices in these mega names rally anywhere between 15 and 50% over the course of the last month. And we think it's gotten a little bit ahead of itself in the short term. So we look at some short-term indicators. If you look at the RSI and the QQQ, it's gone above 80. We've back tested it. It happens very infrequently over the last 25 years. But when it has happened, about half the time you've seen a meaningful downside, a meaningful sell-off over the next month. If you look at the narrowness, even within the NDX, the equal weight versus the cap weighted NDX, that's also gone to extremes. We're not a big believer in breadth being a indicator overall, but the extreme nature of what we've seen over the last month is causing us some concerns. So this is much more of a tactical call. As you know, this has been the part of the market we've liked relative to cyclical, small cap, and everything else.
Yeah. Trading VP of options. Danielle, it's great to have you. And I think to make the important distinction, this is not so much about the volatility we might literally see at the close. It's about the larger signals that you think are an Nvidia and tech pullback that she calls long. $5.4 trillion worth of options expire today in the triple witching, as it's called. And our next guest says it is a key moment to look for an Nvidia and tech pullback that she calls long overdue. Joining us now is Danielle Shea. She's Simpler Trading VP of Options. Danielle, it's great to have you. And I think to make the important distinction, this is not so much about the volatility we might literally see at the close. It's about the larger signals that you think are being triggered here, for lack of a better word. What are you watching?
Well, Kelly, right now we've seen a variety of different factors in which we have the NASDAQ that's made targets. We have Microsoft, Apple, Google has made targets as well, along with Nvidia and Broadcom. So when you have these top weighted products and they've already made extended targets, it's natural for the index to pull back. So at this moment in time, with all of those tickers, I'm not going to be forcing the upside here, but instead I'm going to be looking at additional tickers within tech that are actually already pulled back and consolidated and look like they're going to make a move going into July.
All right, so before we move into that, then the fact that Nvidia has seen this reversal, I don't know what exactly we're talking about, peak to trough the last couple of days.
I'm not looking for anything major because the market has been so strong. That's what will cause traders to suddenly start taking profits, and are seeing Broadcom pull back as well. And so far right now, we're seeing a lot of choppiness in the rest of tech. So it's not quite bleeding into everything else, but certainly it's a big red flag for traders to look for, because when these tickers that have a lot of high volatility start to pull back, that's what will cause traders to suddenly start taking profits and lead to a sharper pullback.
Okay, it's interesting you called out Broadcom along with Nvidia then. So broadly speaking, let's call it the big tech names. What do you think is going on here? Reversals across the board?
Kelly, I'm just looking for a little bit of a pullback. I'm not looking for anything major because the market has been so strong. Volatility has been low. Typically, we look for a pullback to around the 21 EMA on the daily chart, specifically if the NASDAQ futures break through 20,000. That's going to be a key psychological value. But looking at Nvidia in particular, I would love to see a pullback down into 112. I don't know if I'll get it, but 120 I would take. I think that that would be a great pullback where traders can look to potentially sell some put credit spreads, buy some more shares, depending on how the stock acts once it gets to a normal pullback zone. That would be a reasonable spot to start buying again.
To our talk of the tape, whether Nvidia's meteoric rise has happened too fast, and if that incredible run has left the market unstable now. Let's ask our panel. Malcolm Etheridge is Vice President of CIC Wealth, Bryn Talkington, Requisite Capital, Stephanie Link, Hightower. All three are CNBC contributors. Good to have everybody here. Bryn, I'm going to begin with you because you're the one who owns Nvidia. As I said, it had this quick correction of 10%. What do we make of that? Should we be concerned about where this stock is today?
I think it's so healthy. We would be concerned if it just continued to go up 2 to 3% a day. If you just look at basic technicals, it was so far above the 50-day moving average. That number is like close to $100. I doubt it gets there, but it needs to take a breather and consolidate. And I feel quite confident sellers will come in. But remember, earnings don't come out until August 21st. So it's like the very end of earnings season. So there's definitely some time to digest, think about, let it sell off a little bit. But once again, I feel really confident sellers are going to come in because they're going to have another spectacular earnings quarter on August 21st when they crush it year over year on revenues and earnings.
So yes, it does appear as if money managers are starting to get a little bit more concerned about a larger pullback in Nvidia, but still with the baseline assumption that everything's fine, that this is just simple profit taking because the stock has run up so much. And I do think at this point, that's the only conclusion that we can draw, is you're going to get some form of reset or correction. You've really already seen that with the 9% pullback. Could it go a little bit lower? Of course. I don't think you actually get a larger sell-off, any kind of panic until one of two things happens. Either Nvidia outright misses on earnings, which does not look that likely, at least not in the relative near-term future, not this upcoming earnings, that is. Although it is possible we could get some shaky guidance coming August 21st, and that would be problematic for Nvidia since guidance is really the thing that matters most. So I guess a disappointment coming with next quarter earnings is possible. But the second thing is the economy weakening too much, because if the economy weakens too much, what's going to happen? There's going to be a lot of different fears out there, but one of them will be companies slowing down their AI investments if we are actually heading into recession. And obviously, when the Fed makes an error and needs to cut rates because the economy is weakening, that tends to lead to over a 20% crash in the S&P 500 itself. Now, the way I look at Nvidia here in the short term and really the broader markets is pretty simple. Nvidia has sold off about 9%. Nvidia accounts for 1/3 of the gain for the S&P 500. So really what's happened over the past couple of days is other big tech stocks have seen the benefit from Nvidia selling off 9%. And that's why you really haven't seen the indexes fall that much. But I will also mention that crypto is down quite a bit, over 10% from its all-time highs. And when you look at crypto and Nvidia both selling off some of your most risk-on assets, maybe it could be a sign of greater weakness to come in broader markets. Theoretically, you could see Nvidia sell off another 9% or so, and then you could see Nvidia start to recover, and then the rest of the market sell off. Or it's possible that Nvidia can start to do well here. I think you really want to be open for everything. A potential 10% correction in the S&P 500 even before the real start of earnings season, which is about 2 weeks away from now. Or you want to, be positioned or ready for continued American exceptionalism in AI, in big tech. Overall, I'm most bullish on small caps, interest rate sensitive stocks like Tom Lee is, but I do think you need a real material catalyst to get those areas of the markets moving. You need to see the Fed start to cut rates into a strong economy, keyword strong economy, not a weak economy, and you need to see inflation that continues to fall, which I guess goes hand in hand with each other. So that's why this Friday's PCE report will be so important. Also, your personal spending data on Friday, and then your durable goods orders coming out on Tuesday, if I recall, will also be important. Not to mention your GDP growth rate, your final estimate for Q1. So let me know what you think is coming next for our markets. It's pretty obvious. I'm defensive. I have more cash on the sidelines ready to buy, and I think markets have probably run too much at this point, and you need to see a larger pullback. For the S&P 500 to fall to its 50-day moving average, that would be a pullback of about 5.5%. Considering about 60%, almost 61% of stocks are trading under their 50-day moving average, I think that would be a pretty safe kind of assumption to possibly expect about a 5% pullback from here in the S&P 500. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not already done so. You guys, most importantly, have a great weekend, and I will see you in the next one.